Hi, welcome to my new series, Understanding Financing. This is the first video in this series, and today we're going to be talking about the basics of how you finance a real estate transaction. So as this series continues, we're going to cover a variety of topics, including how your income, credit, and assets affect your ability to secure financing, a summary of the loan process, what that looks like, how it works, understanding the role of an appraisal, and also a summary of some of the currently available down payment assistance programs. There are programs available in both Maryland and DC, and so we're going to talk a little bit about that. So let's start at the beginning. When you want to secure a loan, you're going to apply for a mortgage. And that mortgage is going to have a payment that consists of 4 different things. We call it the PITI payment. P for principal, I for interest, T for taxes, and I for insurance. Your principal is going to go as a payment towards the cost of the loan itself. That's however much money you borrowed when you purchased your house. I, the interest, is going to be your payment to your lender because they financed your ability to do this, and that is their payment for doing so. Taxes and insurance are obviously payments towards your property taxes and your house insurance. And if you live in a federally designated flood zone, you'll also need flood insurance. When we look at what this mortgage payment looks like over time, you see something really interesting. And if you've ever had a mortgage before, you see that your initial payments go mostly towards interest and not towards principal. But over time, you'll see that your principal payment gets larger and larger and your interest payment gets smaller and smaller. I'm going to put a chart in my blog, which you can see either on my website or from the link in the YouTube description, and you can see what this payment looks like over time. And you'll see that it isn't until 222 months into a 30-year fixed mortgage that you are going to be making payments where more of the money goes to the principal than the interest. And so I'm going to link you over to a blog on Dan Green of the Mortgage Report put together, and it gives you a few different ideas about how you can make payments that go increasingly towards principal rather than interest. And the easiest way to do this, of course, is make one additional payment per year and then have that money go toward just the principal, designated as such. So I'll link it over in the description so you can take a look at that. When you apply for a mortgage, how is your lender evaluating you? We call these the 3 C's: credit, collateral, capacity. Credit looks at your credit score and other credit-related items. Do you have any liens against you? Have you had a bankruptcy or a foreclosure? What credit accounts do you have? How long have you had them, and what's their current status? And have you requested any new credit recently? Capacity looks at your debt-to-income ratio. This number is a ratio between your monthly income and your monthly expenses. Lenders are hoping to see numbers that are less than 40 to 45% of your income. They're also going to be looking here to see, do you have any cash reserves? Collateral takes into account how the property is going to be used and the down payment provided towards the property. So how much equity is going to be in the house? This takes into account how much are you putting down when you purchase the home. Also, is the house going to be a primary residence or is it an investment property? You're going to see that lenders are going to be looking for a higher down payment amount for investment properties, typically not less than 20%. It's important to keep in mind that when you get a mortgage, you're agreeing to pay back the cost of the loan with interest, and you're using your house as the collateral for that loan. So if you don't make the payments on your mortgage, your lender can take the house and sell it and use the proceeds to cover the cost of the loan. This is a foreclosure. So in our next video, I'm going to be discussing credit, income, assets, and how this affects your mortgage application, and we'll dive in a little deeper to some of the specifics. So check back in with me next week and we'll dive back in.